Question 39 provides us with an extract from the financial statements of WX to give us a breakdown of equity and liabilities showing various movements in the different accounts. The question then asks us to read some statements and identify which one is a valid conclusion that can be drawn from the extracts we've been provided with. So if we just firstly have a look at those extracts, what we can see is that from the 2000X4 to 20X5 years, the share capital has increased, which might suggest an issue of shares, but actually the share premium has decreased by exactly the same amount. That's suggesting to me that that is potentially a bonus issue of shares where we've essentially capitalised some of our share premium into additional share capital. There is a substantial increase in a revaluation reserve, and there's lots of reasons why a business may have done that, but that is interesting to note. And then a reasonably significant fall in retained earnings. Just at the bottom, in terms of long-term borrowings, there's a relatively small increase in those. So looking at the statements, the first is that they must have made a loss in the year. Now that would be an obvious thing to suggest given that retained earnings have fallen, but remember that actually the balance on retained earnings from our statement of changes in equity would be the brought forward retained earnings plus profit or less a loss made for the year, but then less any dividends which have been paid. And so a reduction in the balance on the retained earnings does not itself tell us that there is a loss, although that is possible. It could also be that significant dividends have been paid. The second option is that they may have adopted the revaluation policy to offset the significant loss made in the year and maintain gearing. Now that seems reasonable. We can see that there has indeed been a fall in retained earnings, so to try and counter that, revaluing the assets would help to stabilise the balance on total equity. But we'll come back and have a look at that again when we've reviewed the other statements. The next one is that they have raised finance via a share issue. Again, just looking at the share capital account, that would seem to be the case, but when we also see the fall in the share premium account, those shares have actually been issued as bonus shares, which are free shares issued to existing shareholders. So in itself, the issue of those shares doesn't raise any finance at all. The last of the options is that they must have taken out additional borrowings of $40 million. Whilst there is an increase in the long-term borrowings of exactly that amount, this may not be additional borrowings. It could simply be us taking account of existing convertible debts which need to be increased. So the one that we thought might be correct here does appear to be the correct answer, that it looks likely that they may have adopted revaluation as a way of stabilising equity due to a reduction in retained earnings.